All right, if you would please turn in your textbooks, and we are going to be on page, 275. We're going to be looking at net worth. All right, we are looking at the differences between assets and liabilities. All right, let me grab a highlighter here. All right, so all of this extra mumbo jumbo we don't need, but we need this right here. So your net worth, it is the calculation of the value of everything that you own minus the amount of money that you owe. All right, so a net worth is a statement, includes the calculation as well as a detailed list of everything used to determine the net worth. Assets is included in the value of all accounts investments. It's things that you own. It's money you have. Versus liabilities, okay, think about it. It's a liability. It's a financial obligation or debts. It's that you must pay. All right, they are a negative and they take away from your net worth. Okay, so we're going to take all of these right here and we're going to determine whether they're an asset or they're a liability. So asset, that's a positive thing to us. A liability, that's a negative thing to us. So money in checking account, well, that's money that I have. So that's going to be an asset. So money in checking. All right, a student loan. Well, I had to borrow that money to the bank. So that's a liability to me. So student loan. All right, car loans. Well, that's something that I owe. So car loans is money that I do not have. Vehicles. Now, it's the difference. There's a difference between a car loan and a vehicle. A car loan, that's something that I have because I bought a car and now I have to pay back the large loan on it. But my vehicle, if I were to sell it, it's worth something. So the actual vehicle itself, that is an asset to me, while the loan payment on it is a liability to me. Now, credit cards. We've all heard about credit cards. Credit cards, they will always, always, always be a liability to you. Do not ever get them if you can avoid it. All right, an investment. Think of people when they say they put an investment into something. That is an asset. Investment, that's an asset to me. Now, mortgage. Most of the time, you guys do not know what a mortgage is. This is the same thing as a house loan. So that's going to go over here in my liability. Mortgage, T-G-A-G-E. Your home. So that's the same thing with car loan versus vehicle. Well, mortgage versus your house. Your home goes here. Okay? Because your home is worth something. Now, savings. Well, that's money that I have. That's in my savings account. So that's an asset to me. My retirement money. Retirement. That's money to me. M-O-N-E-Y. Home equity loan. There's that loan word again. So home equity loan. That's going to be a liability. And look, personal loan. There's that word loan again. Basically, anytime you hear the word loan, it's something that is money against you. All right. That is money that is being taken away from you. All right, I've got three friends here. I have Jaden, Lynn, and Melissa. They are disagreeing about whether vehicles should be considered an asset or a liability. Jaden says a car is an asset. Even if you owe money on a car, it is always has the value. Therefore, it's an asset. Lynn says a car is a liability. If you are making payments on a car, it is often worth less than you owe. And then Melissa, a car can be an asset or a liability. It all depends on what the car is worth and how much you owe on it. Who is correct, and explain your reasoning? Well, in this situation, it says all three students are correct. But for us in this, it's going to be Melissa. Where loan is describe a situation where a home loan. So Melissa and us is going to be correct. Now, number 3, it says describe a situation where a home is an asset. So that means that is something that is to me. So one situation is you buy a home and do not owe money on it. Okay? Versus, let's think about a home as a liability. So you buy a home with a loan from the bank. Okay? You buy a home with a loan from the bank, which 90% of the time, you're going to always have to have a loan to buy a house. You will never really, truly, no one that I know of has ever been able to buy a house without a loan. Some people can do it. That's only if they've been saving since they were like 10. Okay, because homes you're looking in the range upwards of like $300,000, and that's just your starter single family home with like 2-bedroom, 1 bath, and that's about it. Okay. Looking at activity 2.2, this is where we get into all of these. You guys have probably heard your parents may or may not have said 401k or 403b. 401k, that is your retirement investment account that's set up by your employer. A portion of employees' pay is invested into the account, with the employer often matching a certain amount to it. A 403b, it's a retirement plan generally for public school employees like myself or other tax exempt groups. Those are usually for you. That's your like version of retirement fund. Okay, so Jamie is curious about his financial health. So he compiles a list of all his accounts. So he's got all his accounts listed here, and he has how much money is in each account. Analyze each of Jeremy's accounts. Create a net worth statement to organize his financial information into assets and liabilities. Okay, so what I want you guys to do is I want you guys to go and I want you to pause this video, and I want you to separate each of these accounts into assets and into liabilities. Okay? All right, so I know that I have the checking account. This will be much easier. All right, so I know I have my checking account. It's an asset. I have 4,210 in here. I have my 401k, which has 60,432. My mortgage, that is $140,000. My home, the worth of it is $175,000. Okay, my truck loan, that is $29,750. Student loan is $34,980. Car loan, $17,680. 403b is $14,953. Credit card is 2350. Stamp collection. Now, my stamp collection, that is money to me. That's what I have. So if I were to sell my stamps, I'm going to sell it for $1,230. Okay. Certificate of deposit. Okay. That is $10,000. Savings account. That is $10,500. Here's another loan, home equity loan. That's $9,750. Investments, okay, that's $2,275. And medical bills is $1,250. All right, and then medical bills, that's something that I owe. I borrowed money from any company or the hospital, and I owe that. So I owe $1,250. Now that you have every single account that has been split up, you need to add up the total. So I'm going to add up all of my assets together, and I'm going to add up all of my liabilities together. And I'm going to keep the two totals separate. Okay. Once you've added everything up together, for your assets, you should have received $278,600. Okay, that's money that you have. Now, money that is against you that you owe to somebody or some company or whatever, it is $235,760. Okay, so determine Jeremy's net worth, show all of your work, and explain your reasoning. Now, in order to find the net worth of someone, anybody, you can find the net worth of any famous person that you want. Okay. To find the net worth, you are going to do this equation. So net worth is equal to my assets minus my liabilities. And then what I have left over, that is what my net worth is. Okay. So I am going to take $278,600 and I'm going to subtract $235,760 from that. All right. And I'm going to see how much is Jerry's net worth. All right, well, 0 minus 0 is 0. Can I do 0 minus 6? No, I need to borrow and carry. 10 minus 6 is 4. I cannot do 5 minus 8, so I'm going to borrow and carry. But I can do 15 minus 7, so 7 to 10 is 3, plus 5 more 5, 6, 7, 8 is 8, comma. Well, 7 minus 5 is 3. 5, 6, 7 is 2. It is 2. 7 minus 3 is 5, 7, 6, 5, 4, 4. Ha. 4, 5, 6, 7, and then 2 minus 2 is 0. So Jerry's net worth is $42,840. $42,840. Okay. If a person's assets to liability ratio is a 1-to-1, what is their net worth? Well, if I have a 1-to-1 ratio, that means my net worth is 0. Okay. This tells me that my assets amount is equal to my liabilities amount. Okay. So say I have $100 in assets, but then I owe somebody $100. Those two cancel each other out. I have a 1-to-1 ratio. All right, number 3, a family's gross income is $65,000 for a given year, with 19% taken out in taxes. They acquire no other assets for the year. Is their net worth positive or negative if the sum of their liabilities for the year earning is $48,000? Show all of your work and explain your reasoning. Okay, so this is going to be a 2-step question. First step is gross income is 65. I need to find out how much is coming out in taxes. So I'm going to go over here and do part, whole, and percent. Okay, part is unknown. My total is my gross income. That is $65,000. I have 19% is coming out in taxes, which remember 19%, I'm going to move my decimal to get me to 0.19. And I'm going to use this equation. Part is equal to percent times the whole. So part is going to equal to 0.19 times the total of $65,000. And let's see, how much is going to come out in taxes for us? 65,000 times 0.19. And I see that I have 12,350 is going to come out in taxes. So I need to subtract my gross amount and take away my taxes of 12,350 minus 12,350. And I see that I earned 52,650. So my assets of how much I'm taking home is 52,650. I'm told my liabilities for the year, so liabilities for the whole year is $48,000. Will the sum of my net worth, will it be positive or negative? Well, if I were to subtract the two numbers, I have more assets than I do liabilities, so my net worth will be positive. Okay, my net worth will be positive. All right. If you guys have any questions, please let us know.